Hello, welcome to Any Answers Answered for November 2019. As ever, Tim and I have chosen a couple of questions from the pages of Any Answers on accountingWEB, and hopefully we'll be able to add some meat to the bones of some of the answers already offered there and give some guidance. Our first question this month comes from Karen Carr, who has asked a question in relation to capital gains tax from April 2020. Karen says, I know that at present it is possible to transfer a property to a spouse, nil gain, nil loss, and the spouse to nominate it as their PPR before selling and the gain being exempt as the property has been their PPR for the whole of the period of ownership. Someone said this would no longer be possible after 6th of April 2020. I can see what they're talking about, Tim, but it's not quite as clear as they're making it.
No, it's a very interesting question and thread, and of course we know that there are several changes coming in from next year on the main residence relief. Very briefly, the terminal period halved from 18 to 9 months, the letting exemption effectively abolished, and two concessions being codified in the legislation. The concession giving an initial exempt period in certain circumstances, and a concession about making a late nomination of which of two or more residences is your main residence. But in addition to those changes, there's going to be a very significant change to the tax treatment following a transfer between spouses. And we know that if one spouse gives a chargeable asset to the other spouse, that is a nil gain, nil loss transfer for CGT, and the donee spouse assumes the base cost and acquisition date of the asset. That's not going to change. But at the moment, the donee spouse will only assume the residence history, if you like, the residence exemption history of the donor spouse, if at the time of the interspouse transfer, they are occupying it as a residence. And in the consultation, the Revenue gave an example. Suppose that George has owned a buy-to-let property since 2010, and in 2016 he marries Nigel, and that rental property, they then decide that they're going to get rid of the tenants and move in and occupy it as their residence. And the Revenue example tells us that immediately before they move in, Nigel transfers the whole of the property to George. That is a nil gain, nil loss spouse-to-spouse transfer. But immediately after they have done that transfer, they move in and occupy it as a residence. And then, if 2 or 3 years later, George, the donee spouse, sells the property, he's assumed George's original acquisition date and base cost, but he hasn't assumed, under current legislation, he hasn't assumed George's residence history. Instead, we look at his own history, and his own history is that from his date of acquisition from George, it was his residence, and therefore the whole of the gain is exempt. So he's washed out that gain. The change in the law from April 20 will be that whether it is before or after they're occupying it as a residence, the donee spouse will in every circumstance inherit the donor spouse's residence history. Now, at the moment, if the transfer from George to Nigel had been after they began to occupy as a residence, then George would have assumed Nigel's history, and so a significant part of the gain would have been chargeable. From April 20, it won't make any difference as to whether they're occupying at the date of the nil gain, nil loss transfer or not. Now, the important practical point there, which is partly what triggered this question in accountingWEB, is what should some clients be advised before April 20? And the answer is to make the transfer before April 20 if they're able to look at occupying as a residence at some point after that transfer has been made.
Because that would then clear this history, as long as the transfer is before April.
Exactly right.
The fact that actually it's not a change to the nil gain, nil loss rules, it is a change to the principal private residence rules that hopefully Karen can now advise their client on that particular point. Our second question this month is from BlackDust567, who asked the question relating to some children buying some shares in a family company. Fairly simple situation, 50-50 husband-wife company. And the question is, two children who are minor children have been left money by their grandmother, and the suggestion has been made that perhaps they could buy some shares in the company, and then we could have the dividends being left in various places and what have you, reducing down the overall tax liability of the family as a whole. I guess people always get excited when it's grandmother, because then the settlement legislation does allow for a transfer down 2 generations where it wouldn't down 1. Well, does it work, Tim?
In a word, no. And looking at the answers that have been posted to this particular question, it's interesting that they focus first on the legal niceties of transferring shares to children in your own company, transferring shares in your own company to children, and also on the capital gains issues. But the original question said it's been suggested that the children use the money to buy the shares, and at the bottom, presumably the children would fill out tax returns and be liable to dividend tax on them to the extent that the income exceeds the dividend allowance plus personal allowance. So clearly the poster is interested in the income tax side of this, the idea being to pay dividends to the children that'll be far more tax efficient. But nobody, as far as I can tell, has addressed that issue. And the simple answer to the question, will it work, is no. You mentioned the grandparents' involvement. Under the parental settlement rules, if a parent makes a settlement of income on a minor unmarried child, then that income is taxed on the parent. Well, it's long established in case law that even if the money derives from a grandparent, where the shares are in the parent's company, and the parent is the controlling director shareholder who votes on dividends, who, if you like, creates the profit in the company, that involvement of the parent is enough for it to fall within the parental settlement rules. Have a look at GM Wildin. There were 2 of them, GM and GR Wildin brothers. One of them, an accountant who, if you Google Graham Wildin, you'll find pictures of his bowling alley and his 2 squash courts in the basement in his home in Gloucestershire, on which he didn't get planning permission, but that's a different story altogether. But he was one of the 2, and money from the grandparents used to acquire shares in the parents' company, it was caught by the settlements legislation.
Had it been the grandparents' company and they had left the shares to their grandchildren,
absolutely fine,
would have been a totally different story.
Totally different story.
But transferring the cash to buy into the parents' company simply doesn't work.
Yeah, a little learning is a dangerous thing.
It is, absolutely. Hopefully useful. Hopefully we have helped both BlackDust567 and Karen Carr. Do post your questions on any answers, and hopefully next time we will be able to look at one of your questions and hopefully answer it. But for this month, bye-bye.